Happy Monday, everybody. Welcome to another episode and a new week of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. We have a big episode today, a lot to cover. Today's video also contains this month's first of two sponsored features. Let's jump in. France's National Assembly has rejected proposals for a wealth tax targeting the super rich, escalating tensions that could topple the newly appointed Prime Minister's fragile government, leading to yet another government collapse. The contentious amendments inspired by economist Gabriel Zucman, sought to impose a 2% levy on fortunes exceeding 100 million euros, $116 million US dollars, despite efforts by socialist lawmakers to introduce a milder, so-called Zucman Light version, exempting family-owned and innovative firms. Both measures were defeated in a series of budget votes on Friday. The government opposed the proposals, arguing that France has never taxed business assets and that such a move would likely be struck down by the Constitutional Council. Nevertheless, the socialists, whose abstentions have been critical in previous confidence votes, warn that they could push for the Prime Minister's resignation if the 2025 budget fails to significantly increase taxes on the wealthy, a move which could collapse the government. The Socialist Party leader said the rejection leaves a €15 billion revenue gap that could otherwise avert looming spending cuts. Quote, "With your intransigence, you're on the wrong path," end quote, added the centre-left leader, accusing the government of stonewalling compromise. France's new Prime Minister downplayed the defeat, saying the outcome, quote, "cannot be described as a show of force," end quote, but acknowledged room for further fiscal adjustments. He pledged to protect pensions and welfare from freezes, a gesture aimed at placating centre-left deputies. Yet the vote is yet another sign of the delicate arithmetic of France's hung parliament, where the Prime Minister, already the third in a short period of time, faces mounting pressure amid credit downgrades and warnings from the central bank of a, quote, "gradual suffocation," end quote, from rising debt. Ironically, the deepening political turmoil comes as France's economy actually shows surprising vigor. New data from Eurostat revealed that euro area GDP grew 0.2% in the third quarter, double economists' expectations, thanks largely to a 0.5% surge in French output, driven by trade and domestic demand. Germany and Italy stagnated, while Spain continued to outperform. The figures arrived just ahead of the European Central Bank's decision to hold rates steady at 2%, reflecting confidence that inflation, hovering near target, will remain contained. Paris's finance minister hailed France's growth as, quote, "remarkable," end quote, urging lawmakers to, quote, "preserve the confidence of businesses and households," end quote. But without consensus on taxation and spending, that confidence could soon be tested. For now, France's economy looks resilient. Its politics, however, anything but. Next up, now we normally do North America, but for today we'll make an exception and cover a South American economy. Argentina's President Javier Milei scored a decisive midterm victory a week ago. We covered this at the time, while the once dominant Peronists suffered their worst national performance in years. The election win has consolidated his grip on power and has set the stage for sweeping economic reforms. Let's examine some of these plans, as well as international and market reactions in the days following his victory. The result sparked jubilation in markets and among Milei's international backers. US President Donald Trump hailed the win as, quote, "making a lot of money for the United States," end quote, while Treasury Secretary Scott Bessent praised Milei's, quote, "decisive mandate," end quote. Investors responded swiftly. Sovereign bonds due in 2035 jumped 13 cents to record highs. The peso strengthened more than 10%, and the main stock index surged 20% the day following the election. A stronger base in Congress, roughly a third of the lower house, will protect Milei's veto powers and bolster his reform agenda. Emboldened by victory and an inflation rate finally cooling from triple digits, Milei is preparing to tackle Argentina's most entrenched economic distortions, its rigid labor market, and one of Latin America's heaviest tax burdens. Quote, "This is nothing less than a paradigm shift in Argentina's economy," end quote, he declared, adding, quote, "We will leave behind the last 15 years of stagnation once and for all," end quote. Milei's labor bill aims to loosen collective bargaining rules, limit costly dismissal claims, and make hiring easier for smaller firms. His tax overhaul would scrap roughly 20 levies, cut income taxes, and redesign how revenues are shared between provinces and the federal government. Economists say such changes could lift GDP growth by up to 2 percentage points annually, unlocking hundreds of thousands of formal jobs by 2027. Yet fierce resistance looms. Argentina's powerful unions have vowed to block any rollback of worker protections, while provincial governors fear losing fiscal control. With just 104 of 257 lower house seats and 24 of 72 in the Senate, Milei must court centrist allies to pass his bills. Analysts see a brief honeymoon window to act. Quote, Milei has emerged in a position of strength. He needs to move fast, end quote, said Marcelo Garcia of Horizon Engage. For now, optimism reigns, but sustaining stability will hinge on rebuilding foreign reserves and managing the exchange rate. As one economist warned, without reserves, Argentina will always be vulnerable to crisis. Milei's next test, turning a landslide into lasting change. What's happening in the world right now can be described in one word: unprecedented. Gold is trading around $4,000 per ounce, and billionaire hedge fund managers, including Ray Dalio, recently compared the current situation to the mid-1970s, and he advised investors to own more gold than usual. Billionaire fund manager and bond guru Jeff Goodluck is saying having 25% in gold isn't excessive. The Trump administration is making changes at the Fed, and in recent weeks has taken significant equity positions in mining companies. 2025 has experienced a seismic shift in gold, and silver and copper are also near record highs as well. The sponsor of today's video, US GoldMining Inc., ticker symbol USGO on the Nasdaq, could be in a prime position to take advantage of this bull market. Its Whistler project in Alaska contains the closest large undeveloped gold-copper exploration project to the main population center of Anchorage. In early October, President Donald Trump and the Secretary of the Interior announced that the administration, acting on their previous executive orders regarding mineral resource opportunities in the state of Alaska, gave approval to the Amber Road project, a proposed 211-mile road to the Amber Mining District, a key piece of infrastructure to unlock access to the mineral resources in northern Alaska. The importance is the market signal. It tells us that Alaska is officially open for business. Alaska is clearly important for Trump's administration. Trump issued an executive order on day one of his presidency called Unleashing Alaska's Extraordinary Resource Potential. The administration then issued a second executive order. The executive order directs government agencies to immediate action to facilitate domestic mineral production to the maximum extent possible, including copper and gold. In addition to federal support at the state level couldn't be stronger. Alaska Governor Mike Dunleavy is a strong proponent of economic growth and the infrastructure to support mining in his state, and he has personally visited the Whistler project himself. Along with this support, the project has, in 2025, been visited by the U.S. Senator Lisa Murkowski and by U.S. Representative Nick Begich. The Whistler Project mineral resource estimate comprises 294 million tons at 0.68 grams per ton gold equivalent for 6.48 million ounces gold equivalent in the indicated category, plus 198 million tons at 0.65 grams per ton gold equivalent for 4.16 million ounces gold equivalent inferred. You should review U.S. Gold Mining's latest annual report on Form 10-K and the technical report summary incorporated in it, and its Canadian technical report titled N143-101 2024 Updated Mineral Resource Estimate for the Whistler Project, South Central Alaska, with an effective date of September 12, 2024. For information on the company, the project, and the mineral resource estimate, these are available under US Gold Mining's profile at www.sec.gov and www.sedarplus.ca. The company's ownership structure is also noteworthy. 78% of the outstanding shares are held by the parent company. The Trump administration has issued 2 executive orders on Alaska, and the state is moving forward with a planned road system, the West Susitna Access Project, that will connect the Whistler Project with Anchorage. And now one of the company's most important moments since conception is in the works. US Gold Mining has begun the process of initial economic assessment, also known as the PEA, Preliminary Economic Assessment. This study is a preliminary review of economic factors, and the timing couldn't be any better, with gold around $4,000 per ounce and copper around $5 a pound. Do your own extensive research on US gold mining, symbol USGO on the Nasdaq. Make sure you review US Gold Mining's annual report and other filings with the SEC when you research this opportunity. This is a sponsored feature. It is not individual investment advice. A big thank you to US GoldMining Inc. for sponsoring this episode of Market Update. We now return to regular market update coverage. Indonesia has entered debt restructuring talks with China over its $7.3 billion so-called Whoosh high-speed rail, as the flagship Belt and Road Initiative project faces mounting financial strain just 2 years after launch. The 145-kilometer line connecting Jakarta to Bandung, jointly developed by Chinese and Indonesian state-owned firms, was heralded as a symbol of modern connectivity. Now it risks becoming a financial millstone for both governments. 3/4 of the project's funding came from Chinese loans, and despite its technological achievement, the line has failed to attract sufficient ridership. Tickets cost more than 5 times the price of slower trains, while stations are inconveniently located far from city centres. Passenger numbers have reached only a third of projections, according to a parliamentary report. Losses have mounted. The Indonesian consortium, which holds a 60% share, reported deficits of $253 million in 2024 and approximately $100 million in the first half of 2025. The investment minister confirmed that Jakarta is seeking a comprehensive debt restructuring to prevent a potential default, while the finance minister has ruled out a state bailout. The Nantara, Indonesia's newly established sovereign wealth fund managing all state enterprises, has taken over the talks with Beijing. Its COO, Doni Oskaria, said negotiations focus on extending loan maturities, lowering interest rates, and adjusting currencies, with a deal expected by year-end. The project was championed by the former president, Joko Widodo, as a centerpiece of Indonesia's infrastructure transformation, while for China it showcased the global reach of Xi Jinping's Belt and Road Initiative. Yet the financial outcome has cast a shadow over both countries' ambitions. The current president's expansive spending plans already strain state finances, and the rail project's government guarantees further amplify fiscal risks. Critics argue that the project's challenges were predictable. One economist from the Institute for Development of Economics and Finance noted that the short distance between Jakarta and Bandung never justified a costly bullet train. Indonesia's decision to favor China's proposal, which offered a 2% interest loan without state guarantees over Japan's cheaper 0.1% offer with guarantees, has also drawn scrutiny. When costs ballooned, Jakarta reversed course and provided state backing, deepening its exposure. Other Belt and Road Initiative projects globally have undergone similar restructurings, with Beijing forgiving or deferring debt. Aid Data's Brad Parks expects China to suspend payments temporarily, though repayment timing remains uncertain. One McKinsey Research Fellow suggests that Beijing's priority will be ensuring Jakarta's continued involvement, even if China must delay returns. Still, with China itself stuck in its own economic slowdown and property crisis, she doubts Beijing would take direct control of the project. For Indonesia, the Whoosh train remains both a symbol of ambition and a cautionary tale. A high-speed dream now slowing under the weight of its own massive debt. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I hope to see you for another episode tomorrow.